Right now, you've got two people screaming in your ear. Your uncle, the one who owns 3 rental properties, drives a Range Rover, and never misses an opportunity to bring it up at family dinner. Buy real estate, kid. They're not making more land. He says it every single time like it's scripture. And then there's your coworker, the one who turned $10,000 into $80,000 during the 2020 bull run, who slides into your DMs with TikToks about index funds, compound interest, and why Warren Buffett is basically a god. He's convinced the stock market is the only answer. So here you are, $50,000, 2 completely opposite pieces of advice, and no idea who to believe. That's exactly what we are breaking down today. Real estate versus stocks. Not in some dry textbook way that puts you to sleep. We are going deep. Historical returns, risk, liquidity, leverage, taxes, passive income, accessibility, psychology, and everything in between. And by the end of this video, you are going to know exactly which one fits your situation, and maybe even how to use both to build the kind of wealth most people only dream about. My name is Max. If you're new here, welcome. We talk about money, investing, and financial freedom in a way that actually respects your intelligence. Hit subscribe, because this is the kind of content that will genuinely shift how you think about building wealth. No fluff, no hype, just real talk. Let's get into it. Round 1. Historical returns. What do the numbers actually say? Let's start where every serious financial conversation should start, the cold, hard data. Because everyone has an opinion, not everyone has the receipts. Over the last 30 years, the S&P 500, a basket of the 500 largest publicly traded companies in America, has returned an average of approximately 10 to 11% per year. And understand what that number includes. It includes the dot-com bubble completely destroying portfolios in the early 2000s. It includes the 2008 financial crisis, one of the worst economic disasters in modern history. It includes the brutal COVID crash of March 2020, when markets dropped 34% in a matter of weeks. Through all of that, 10 to 11% per year, average, annualized. That number is genuinely hard to argue with. Now let's look at real estate. National average home appreciation in the United States has historically sat around 4 to 5% per year. On the surface, it looks like stocks win easily and we can all go home. But here is where most people, including a lot of so-called financial influencers, get it fundamentally wrong. Real estate returns are not just appreciation, not even close. When you own a rental property, you are also collecting rent. Every single month, cash money in your account. Add that rental yield, which typically sits somewhere between 4 and 8% depending on the market, the property type, and how well you manage it. And your total annual return on real estate starts looking dramatically more competitive against stocks. But wait, we're still not done. Because real estate has one weapon in its arsenal that stocks simply do not have. One mechanism that changes the entire mathematical equation. It's called leverage, and it is the single most important concept in this entire debate. Here's how leverage works. When you invest $50,000 in the stock market, you own $50,000 in assets, 1-to-1, dollar for dollar, simple math. But when you put $50,000 as a down payment on a $250,000 property, you now control $250,000 in real estate. You used your $50,000 to command 5 times as much asset value. So when that property appreciates 5% in a year, that's $12,500 in value gained on a $50,000 investment. That's a 25% cash-on-cash return, not 5%, 25%. Because you weren't just earning on what you put in, you were earning on the total asset value the bank helped you control. That's leverage. That's why real estate made so many ordinary people extraordinarily wealthy. And that's why comparing raw appreciation percentages without accounting for leverage is a completely incomplete analysis. Round 2. Liquidity. Can you actually get to your money? Here's a topic that almost nobody talks about seriously when they're romanticizing the idea of becoming a real estate mogul. Liquidity. And it matters more than almost anything else on this list, depending on where you are in life. Liquidity simply means how quickly can you convert your investment into usable cash? With stocks, the answer is essentially immediately. You open your brokerage app, you hit sell. Within 2 business days, the cash is sitting in your account. You need $15,000 for a medical emergency. Done. The market shifted and you want to rebalance 5 minutes. You changed your mind entirely. Sell it all by Tuesday. The flexibility is extraordinary. Real estate is the polar opposite experience. Selling a property is a multi-month process under ideal circumstances. You list it. You wait for interested buyers. You negotiate. You go through home inspections. You wait for the buyer's financing to be approved. You handle appraisals, title searches, and closing paperwork. We're talking 60 to 90 days minimum when things go smoothly. And when things don't go smoothly, buyer's loan falls through, inspection uncovers issues, market conditions shift. You could be looking at 6 months or more. And during every one of those months, your capital is locked inside those walls. You cannot sell 1 bathroom to raise quick cash. You cannot liquidate 15% of the living room for an emergency. It is all or nothing, and nothing happens fast. Yes, tools like a home equity line of credit, a HELOC, allow you to borrow against your equity without selling. But that introduces debt, interest payments, and new monthly obligations. It's a workaround, not a solution. The bottom line on liquidity: if you're in your 20s or early 30s, still building your financial foundation, still potentially facing life pivots, job changes, moving cities, starting a family, that flexibility that stocks offer is genuinely priceless. Don't underestimate it. Round 3. The passive income myth. The truth about being a landlord. Let's address one of the most aggressively oversold narratives in the personal finance space right now. The idea that rental income is truly passive, that you buy a property, sit back, and collect checks while you sip something on a beach somewhere. I'm going to be honest with you in a way that a lot of channels won't, because they're too busy selling you a real estate course. Owning rental properties is a business. It is active income disguised as passive income. You have tenants calling at 11 p.m. because the heating stopped working in January. You have month-long vacancies where you're covering the full mortgage out of your own pocket while simultaneously trying to find a new tenant. You have maintenance, and the standard rule of thumb is to budget roughly 1% of the property's value annually just for upkeep and repairs. On a $300,000 property, that's $3,000 a year in an average year. When the HVAC system dies, when there's a roof leak, when a pipe bursts, that's $8,000, $12,000, even $20,000 in a single event, coming straight out of your pocket. And then there's the interpersonal reality of managing tenants, late payments, disputes, evictions, which, depending on your state or country, can be a legal nightmare that drags on for months while you still can't collect rent. Now, does all of that mean real estate is a bad investment? Absolutely not. Because when everything works, when you have a reliable long-term tenant, low vacancy, a well-maintained property in a neighborhood with solid demand, rental income is one of the most consistent and predictable cash flows available to regular investors. Month after month, the money hits your account. Market crashes, your rent check still comes. Volatility spike doesn't affect your tenant's lease. Dividend stocks, on the other hand, provide genuinely passive income. You own shares. Dividends are deposited automatically on a set schedule. No calls, no repairs, no tenant drama. However, dividend yields on most solid ETFs and blue chip stocks sit between 1.5% and 4%. On a $300,000 portfolio, that's between $4,500 and $12,000 per year. Reliable, truly passive, but typically lower than a well-operated rental property's cash flow. The honest answer is, real estate cash flow potential is higher, but you earn every dollar of it. Round 4. Taxes, the arena where real estate dominates. Forget everything else for a moment, because when it comes to tax advantages, real estate doesn't just beat stocks, it embarrasses them. Let's start with depreciation, which is arguably the single most powerful legal tax strategy available to everyday investors. The IRS allows you to depreciate a residential rental property over 27.5 years. In practical terms, if you own a rental property worth $300,000, you can write off approximately $10,900 per year as a depreciation expense, reducing your taxable income, even if the property is simultaneously going up in value. You are receiving a tax deduction for a fictional loss on an asset that's appreciating. That is extraordinary. On top of depreciation, you can deduct mortgage interest, property taxes, insurance premiums, property management fees, maintenance costs, legal fees, and even mileage driven to visit the property. The list of deductible expenses in real estate is genuinely massive. Then there's the 1031 exchange, which is essentially a legal mechanism to defer capital gains taxes indefinitely. When you sell an investment property and roll the proceeds into another qualifying property within the required time frame, you pay zero capital gains taxes on that transaction. You can do this repeatedly over your entire investing lifetime, building larger and larger portfolios while continuously deferring the tax bill. This is a strategy used by some of the wealthiest real estate investors in the world, and it is fully available to regular investors. Stocks. When you sell, you pay capital gains taxes. Short-term gains, assets held less than a year, are taxed as ordinary income, which depending on your bracket could be 22%, 24%, even higher. Long-term capital gains rates are lower, but you're still paying. And dividends? Taxed every single year, whether you wanted the income or not. Tax-advantaged accounts like Roth IRAs and 401ks help significantly on the stock side. But even accounting for those, the raw structural tax advantages embedded in real estate investing are on a completely different level. If building long-term wealth efficiently, meaning keeping as much of your returns as legally possible, is a priority for you, real estate wins this round decisively. Round 5. Risk. What actually keeps you up at night? Both asset classes carry real risk, but the type of risk is so different that comparing them directly can be misleading. With stocks, the primary risk is volatility. Your portfolio can drop 30%, 40%, even 50% during a major bear market. This is not theoretical. It has happened multiple times within the last 25 years. The psychological experience of watching your net worth cut in half on a screen is genuinely brutal, and the data shows that most retail investors don't handle it well. They panic at the bottom, sell at a loss, and lock in damage that the market would have eventually recovered from. The risk in stocks is less about the asset class and more about the human being managing the account. With real estate, price drops don't appear on a dashboard every 30 seconds. Your house doesn't show you a live percentage change while you're eating breakfast. That psychological buffer is actually one of real estate's underrated advantages. The natural illiquidity forces a kind of behavioral discipline that protects investors from their worst impulses. But real estate carries its own serious risks. Concentration risk. Most real estate investors have the majority of their net worth tied to one or two properties. If the local economy deteriorates, if a major employer shuts down, if the neighborhood declines, you have almost no diversification to protect you. Leverage risk. The same amplification that makes your gains look spectacular also makes your losses devastating. Put $60,000 down on a $300,000 property that drops to $240,000, and you've lost your entire down payment on paper. The bank doesn't absorb that loss, you do. Vacancy and cash flow risk. A vacant property doesn't pause the mortgage. It still costs to pause the mortgage. It still costs money every month, regardless of whether it's generating income. The verdict on risk. Stocks are more volatile, more emotionally demanding, but easier to diversify. Real estate feels more stable, but carries hidden, concentrated risks that can be catastrophic when they materialize. Round 6. Accessibility and getting started. This is one of the most important rounds and one of the least discussed. Not everyone can buy an investment property, full stop. The minimum down payment for a non-owner occupied investment property is typically between 15% and 25%. On a $300,000 property, which is not even an expensive market, that's $45,000 to $75,000 before you account for closing costs, initial repairs, reserve funds, and carrying costs during the first vacancy. Realistically, you need $80,000 to $100,000 in liquid capital just to get started the right way. That's a serious barrier. For most people in their 20s, that capital simply doesn't exist yet, and that's okay. But it's important to be honest about it. Stocks have almost no barrier to entry. You can open a brokerage account today. You can invest $50, $100, or $500 this week. With fractional shares widely available and zero commission platforms everywhere, a 22-year-old working their first job can start building a real investment portfolio immediately. The stock market's wealth-building power is genuinely democratic in a way that direct real estate ownership is not. Now, this gap is shrinking. REITs, real estate investment trusts, trade on the stock market like any other stock and give you exposure to real estate income and appreciation with a few dollars. Real estate crowdfunding platforms allow investors to pool capital into institutional-grade properties. But for direct property ownership, with all the leverage and tax advantages that come with it, you still need significant capital. That is the reality. Round 7. The psychology of wealth building. This is the round nobody talks about, and it might be the most important one of all. The single biggest threat to long-term investment returns is not market crashes, bad tenants, or poor stock picks. It is the investor's own behavior. Emotional decisions made in moments of fear or greed cause more wealth destruction than any external market event. Stocks make this hard because they are constantly visible. Your phone shows you the number changing. Financial media creates daily narratives about why everything is either about to explode or completely collapse. The temptation to react, to sell, to buy, to shift is relentless. Most people give in. Most people lose returns because of it. Real estate's illiquidity, which looks like a weakness on paper, is actually a psychological fortress. You can't panic sell your duplex at 2 a.m. because you saw a scary headline. The friction of the process protects you from yourself, and that protection has real measurable value over long-time horizons. The best investment is consistently the one you can actually stick to. For many people, real estate's psychological profile makes it easier to hold and stay the course. For others, the automation available with index fund investing, set up automatic contributions and never think about it, provides a similar behavioral guardrail. Know yourself, seriously. Your own psychology is a bigger variable than most people account for when choosing how to invest. Round 8. The real answer. Which one actually builds more wealth? Here it is. The real answer. The one that took me years to fully understand. The debate between real estate and stocks is, at its core, a false binary. The wealthiest investors in the world, the ones who built generational wealth, not just comfortable retirement accounts, did not choose one or the other. They use both, deliberately, with each asset class serving a specific purpose in a broader strategy. Stocks for liquidity, for global diversification, for the compounding growth of the world's greatest businesses, for simplicity and accessibility, for the ability to move capital quickly when opportunities arise. Real estate for leverage, for monthly cash flow, for extraordinary tax advantages, for inflation protection, for the ability to force appreciation through improvements, for the psychological comfort of a tangible physical asset. Together, they don't just coexist, they complement each other. A real estate investment producing consistent monthly cash flow funds additional stock market contributions. A stock portfolio growing quietly in the background builds the capital needed for the next property down payment. The two engines feed each other. But if you're asking where to start, here is my genuine, honest take. If you're young, still building your income without substantial capital, not yet ready to be a landlord, start with stocks. Build the habit, invest consistently into low-cost index funds. Learn how markets work. Let compounding begin. It is unglamorous. It does not make for an exciting social media post. And it absolutely, unambiguously builds real wealth over time. When the capital is there, when your income is stable, when you've educated yourself on cash flow analysis and property management, add real estate. Claim the leverage, collect the rents, use the tax code the way wealthy investors have been using it for decades. Build the income stream that doesn't depend on clocking in somewhere. And do both, simultaneously, in proportions that match your income, your risk tolerance, your timeline, and your life. See you in the next one.